feeder by 8.
Okay. All right, I'm going to get going.
Just a second, Hugh. Just a second, Hugh. I'm going to start streaming. I need to do 2 more things, and I'll let you know.
Mm-hmm.
Lucas, did you say you were in Mexico City?
Yeah, we're here in Mexico City right now.
It's an amazing place. I haven't been there in years, but it was so big in a museum. Oh my God.
So we are live now.
Okay, right.
All right, at CFA Boston, August 30th is Young Leaders Networking Reception. September 15th is Communicating Up the Leadership Ladder. September 21st is Allyship. How does it work and why? And September 30th, Standards and Convergence and Coexistence Series, Value Reporting Foundation. And Dan wanted me to announce this. Northfield Newport seminar is scheduled to go forward on October 13th. If the COVID situation worsens to the point where the meeting is unavailable, the material will be presented in 2-hour sessions from October 13th to October 14th. Okay, and do you have anything from Quant University? Okay, Dan diBartolomeo is president of Northfield. His record of research publications includes more than 50 peer-reviewed and textbook chapters and books. Dan holds leadership positions with numerable professional societies, including CQA and IAQF and Boston Quaff a few. And he recently became the editor of the Journal of Asset Management. So Dan, take it away.
Thank you, and thank everybody for coming to what I hope will be our last online meeting only. Hopefully within a month or two, we'll be back to live meetings. I apologize in advance if there's any background noise. I am doing this event from home, and my dog has been known to bark from time to time. Hopefully she won't have any reason to do so. The topic for tonight is estimation of cryptocurrency risk. I did a webinar about this topic back in June. And since then, I've added to the discussion a way in which we have chosen to combine market risk and operational risks. We believe that the operational risks associated with cryptocurrencies are both significant and substantial. And so we wanted to have a way to combine the two things, which we have done. Let me now try and move the slides. And slides are choosing not to move for me. So give me a sec here, folks. Well, I can guess what the rest of the slides say, but let me, oh, here we go. So just to start off, the value of all cryptocurrency now exceeds about 1% of traded wealth. If you look at all the traded financial markets in the world, they now add up to about 170 trillion in market value. And the value of cryptocurrency is about 2 trillion if you include all of the 4,000 or so defined cryptocurrencies that we've been able to find. I'm going to talk in a minute about just a very brief review of some research literature from the academic community on cryptocurrency risk. The main portion of the presentation is going to be about understanding cryptocurrency risks and how we're choosing to approach those in a forward-looking fashion. In particular, there are some very significant nuances to how we're building a covariance matrix, both within different cryptocurrencies and also between cryptocurrencies and other assets. I'm just going to stop for a second and make sure everybody's hearing me. Please nod up and down for yes, sideways for no. Okay, good. And then the last portion of the talk is going to be devoted to some of these tail risk properties that may arise in cryptocurrencies, either because of geopolitical events, like cryptocurrencies are outlawed by a large number of countries, or some of the operational risk issues that have shown up in cryptocurrencies, things like theft, things like loss of private keys, which are necessary to demonstrate ownership of cryptocurrency and transact it. And I'm going to do that using a very familiar technique that is known as a combination of what are known as mixture distributions and a particular calculus approximation known as the method of Cornish and Fisher. So just to try and motivate the talk a little bit, there's been a lot going on in cryptocurrency in recent months. There have been a lot of up and down in the prices and the values. The landscape of sort of institutional participation is evolving rapidly. Some firms like Goldman Sachs are setting up trading desks to do this. Here, back in Boston, our home, Fidelity has set up custody facilities for Bitcoin and ability to trade Bitcoin. There are other financial institutions like HSBC, Hong Kong Shanghai Bank, that have basically said, no way, no how, we want nothing to do with it. And are advising their clients to stay away from crypto as well. Several countries, particularly in Asia, have started enforcement actions against one large crypto firm called Binance, which is based sort of halfway in Singapore and halfway in Hong Kong. And also China has begun to aggressively regulate crypto activities within its border, particularly Bitcoin and other forms of what is known as cryptocurrency mining. Another thing that brings this to our attention is that last week, hackers managed to steal about $600 million from a crypto trading network called Poly Network. Unlike a crypto exchange, Poly Network is a peer-to-peer facility. So one individual who owns cryptocurrency can sell to another, but there is nothing like a virtual trading floor where all the trades flow through. This reminds me a lot of the early days when people were trading musical recordings on systems like Napster. So if you had a bootleg copy of a song, you could send it to your friends. Interestingly, about half the money in the Poly Network case has been recovered. The thieves have been convinced to give the money back. However, this is the third crypto theft of over $500 million. So these are not isolated incidents, and they are not small. As I said, there is a variety of sort of institutional interest in this issue. And we believe that whether you agree with the ideas of cryptocurrency having an intrinsic value or some sort of extrinsic value, I think this sort of stuff is going to be turning up in our client portfolios from time to time. So we thought about how to deal with it. And we are going to be covering at least the more prominent cryptocurrencies as a currency in the way our models work in the future. And I won't go into this in detail because it's fairly Northfield specific, but there is an article in our March 2021 newsletter about how we have a particular statistical process for analyzing commodities and how that statistical process has been broadened, if you will, to include currencies from frontier markets like Syria or Tajikistan, and also to be extended in the same way for cryptocurrencies. As I said, there isn't much of an academic literature in cryptocurrency risk. One paper that I think is reasonably useful is a paper by Alexander and Imeraj. Many of you have probably heard the name Carol Alexander in the past. She's a quite prominent UK finance professor, does a lot of stuff around risk. And they had a paper a year and a half ago or so, and it basically says for the major cryptocurrencies like Bitcoin and Ethereum, they have observed volatility on the order of 5 to 6% per day. And if you annualize that in the usual way, the way we would typically do so under the assumptions of portfolio theory, you get a vol something on the order of 80%, which is very high and consistent with maybe a very micro cap sort of US stock or some small company in an emerging market. There's also a more recent paper by Schwenkler and Zeng. And what this basically shows is that there seem to be pair relationships across cryptocurrencies, so that if there is a price shock up or down to a particular cryptocurrency, there is a predictable effect on the other member of the pair. And I posted a link to that particular paper. But again, this paper and this idea of linkages between cryptocurrencies is also consistent with the analytical method that I'm going to describe in a minute for how my firm is approaching the idea of cryptocurrency risk or frontier currency risk in general. The other thing that I wanted to bring to your attention is that one of the purported properties of cryptocurrencies is that each one has a limited supply. For example, it is asserted that the maximum number of Bitcoins that can exist is 21 million. And in some ways, that is similar to the idea of an exhaustible natural resource. If you think of gold or copper or oil, once you've gotten it all out of the ground and done something with it, well, you don't have any more. And it brought up in that context a very old economic principle known as Hotelling's principle that basically says mining operation is too costly. The miners will leave the resource in the ground and wait for the price to go up until they bother to mine it again. And they develop an equilibrium model of this. And back in 1993, 28 years ago now, I wrote a paper on that type of relationship between the price of gold bullion as traded in the world gold markets and the prices of stocks, equities in mining companies. And I think this gives us a very good clue as to how other types of entities that may become public companies, like Bitcoin mining operations, and there are several already traded in the United States and Canada, cryptocurrency exchanges and so forth, may behave relative to the behavior of the cryptocurrencies themselves. So I wanted to bring that up as a point of reference, but it really all goes back to this idea of the Hotelling principle, which is specific to resources that have fixed and limited supplies. As I said, the way we think of cryptocurrencies is closely related to how we think about commodities. For one thing, crypto is legally considered a commodity in most of the developed world. If you think about what agency of the US government might try to regulate cryptocurrency, it would be, at this point, the Commodity Futures Trading Commission. Securities that are associated with cryptocurrency, like equity shares in mining companies, would of course be regulated by the SEC. But essentially what we're doing is we're creating clusters, groups of currencies, in fiat currencies, in real national currencies. You could think about those clusters being based on things like geographic proximity, trade relations, cultural similarity. Now, crypto will be its own cluster, and that cluster will be subdividable into various groups that seem to have certain types of similarities among them. Obviously, some of that clustering will be a matter of statistical estimation. And essentially what happens is once you've built a cluster, you represent the covariances among the members of the cluster as a principal component analysis. And then the factors which are extracted from the principal component analysis are mapped onto the factors of whatever empirical risk model is in use at the time. So if our model has things like oil prices in it or the currency of the neighboring country, the factor loadings, the PCA loadings, will be mapped onto those real world factors. And this is what allows us to create estimates of covariance between the members of the cryptocurrency cluster and other assets, equities, fixed income, currencies of developed countries, and so forth. The final step in this process is to adjust the volatility of a particular currency for what we think of as geopolitical and operational risks. And that is largely driven for fiat currencies by the country's sovereign credit rating. If you think about a country that is in economic disarray, say Venezuela or Lebanon, if they were to try and borrow US dollars from the market, not from the IMF or some other agency which is prepared to subsidize them, but actual market rates, Venezuela or Lebanon would be paying very, very high interest rates to borrow US dollars, and that extra interest, that spread, is indicative of the perceived geopolitical risk of those countries. And I'm going to present to you later in this presentation how we do that with respect to the operational risks of cryptocurrencies, things like thefts and lost keys. So, as I said, the cluster for cryptocurrencies is going to include the cryptocurrencies themselves, certain fiat currencies, certain national currencies that we believe have some appropriate properties, like Swiss francs, a currency in which it has been very common in the past for people to try and obtain anonymity in their financial dealings, and certain commodities that have a perceived tradable global financial value, things like crude oil, gold. Now, once we've defined that cohort set, the analytical process has some nuances that have to account for some uncommon features. The first one is that, in portfolio theory, we usually use the assumptions of random walks and IID distributions. Clearly, cryptocurrencies to date have not exhibited that kind of behavior. They've exhibited high degrees of higher moments, skew, kurtosis, and serial correlation in the returns. Now, we can only speculate about how these other behaviors arise. And some of that might just be the fact that there's speculative interest from retail investors that sort of comes and goes. There is, if you will, erratic interest from major financial institutions. And there are clearly market fears or market concerns that cryptocurrencies could lose significant value by virtue of regulation. Finally, there's the issue of operational risk. We know that there have been at least 3 thefts of at least $500 million each, and many smaller such events, certainly over 2 billion in thefts and other sort of operational problems, most of which are yet to be resolved in any way that is satisfactory to the participants. Now, with respect to the idea of this non-IID behavior, what we're trying to do is employ 4 particular analytical markets, 4 particular analytical techniques. Give me 1 second. I'm going to mute the dog. Hold on 1 second, guys. Hey. Sorry about that. Your dog is now quiet. But basically, there's 4 things that we have to do to try and make the numbers look reasonable, given this very unusual behavior. The first one is that we're not actually even defining volatility in the typical measure of standard deviation. We're actually using a root mean square. And what that basically means is that the standard deviation is typically dispersion around the mean. And in this case, we're just going to treat the mean as if it were 0, no matter what the mean actually is. And why we think that's important is that imagine a case where a particular asset value rises 10% a month every month for 2 years. And this is really what happened with internet stocks in the late 1990s. The returns would have a standard deviation of 0. And so under the conventional measure, they would be perceived as riskless. Now, it's our intuition that if something is going up 10% a month, that can't continue forever. There has to be a point at which that process stops. And so we would much rather not have that series of returns perceived as riskless. And so for many, many, many years, we have always treated factor returns, that is the building blocks of asset returns defined as factors, as having this idea that the factor mean return should be close to 0, irrespective of what it actually is. And another good example would be the Japanese equity market, where it went almost straight up through the entire decade of the 1980s, and then almost straight down through the entire 1990s. And we've published on this before. I've given you a link to one of the papers, and that was in fact published at the time. The second thing we're doing to try and capture the unusual behaviors of cryptocurrencies is the idea of thinking about volatility in price range. The usual measure of volatility that we would see in portfolio theory is standard deviation of return, or whether it be per day, per week, per month. A different way to think about volatility would be to simply say, if I observe the price of an asset over a particular time interval, a day, a week, a month, and think about the range in price between the lowest price and the highest price. If those two prices, the high and the low, are close together, the asset's not very volatile. If the high and the low are far apart, they're volatile. And there have been a whole bunch of papers, starting really with a paper by Michael Parkinson in the Journal of Business in 1980, that basically show that if returns have our usually assumed properties of being IID random walks, there's a direct algebraic transformation between this kind of range, price range measure and standard deviation. And if you try to do that transformation and the numbers don't match, then you have some aspect of the behavior that is not IID. And just to illustrate a very, very, very simple range measure, this is not what we actually use, but this is actually used a lot by option traders as a way of thinking about volatility, is just the difference between the high and the low divided by the sum of the high and the low. And so if you had an asset that had a low price of $1,000 and a high price of $3,000 over a particular month, you would get a volatility of 50% a month. 3,000 minus 1,000 divided by 3,000 plus 1,000. And again, there's a direct transform between that kind of concept and the usual way of thinking about standard deviation of return if you have a random walk process. The third element of how we think about cryptocurrency risk estimation is the idea of carry trades. And that's simply the idea that if I can borrow money in one currency and deposit it in another currency where I get a higher interest rate, I can make the spread. Now, the risk associated with making that spread is, of course, the fact that the exchange rate between the two currencies move. And so there has to be built into that process some assessment for the participant between the reward, the interest rate differential that they earn relative to the volatility of the exchange rate. And so if the carry trade has a large interest rate differential, you would think lots of people would do that unless they thought it was very risky to do. And so you can make an inference about risk based on sort of an equilibrium conception of the carry trade differential. The other thing that's important here is that in many countries, and particularly with cryptocurrency, the idea of borrowing or of the currency, or the idea of depositing the currency in some sort of interest-bearing account may not carry any kind of government deposit insurance. So in addition to the exchange rate risk, there is counterparty failure. Whatever institution you're dealing with can go broke and disappear. Right now, if you go on the internet, you can find things labeled Bitcoin savings accounts that have yields in excess of 8% a year, as compared to something close to zero for retail savings accounts in the United States. So there's a very large interest rate differential, and one would presume that that differential would narrow. People would do this a lot and drive down the benefit if they didn't think it was very, very risky. The last thing that we use as a building block of the risk assessment for crypto is the idea of convenience yield. Obviously, there is a certain percentage of participants in cryptocurrencies who wish to use cryptocurrencies because they believe that it will make their transactions anonymous and difficult to trace. This could be anybody from a spouse contemplating divorce, trying to hide assets from their spouse. It could be criminals. It could be tax evaders. It could be simply honest investors in countries that have capital controls that don't allow you to invest outside the country. There are certainly many, many countries in the world where foreign investing is very restricted. Now, obviously, it's hard to quantify how many people are out there using cryptocurrencies for what might be considered the purpose of anonymity, the purpose of why people used to have the old Swiss bank secret bank accounts, why people for many years placed money in tax havens like Panama or the Cayman Islands. And if you go back to the 1980s, when Swiss banks were perhaps at their peak of activity in this regard, Swiss banks routinely offered negative interest rates on savings accounts at a time when US banks were offering around 5%. So at least a certain fraction of financial market participants were willing to forego 5% a year interest on their bank account in order to remain anonymous. So if you add those two together, you've got these observable measures of the observed volatility of the prices. Plus, you have this idea of the efforts to try and reduce the risk of crypto investments. One of those is the so-called concept of a stable coin. And a stable coin is sort of like the old days when banks in the 18th century would issue their own paper money, and each bank would issue its own bank notes, as they were called. There are commercial banks still in many places, Hong Kong and even Scotland, that still routinely issue their own banknotes. Now, in those places, the money is legal tender, but still is labeled as having been issued by a particular bank. Now, to stabilize or purportedly stabilize the value of cryptocurrencies in US dollars, these stablecoin structures appoint a custodian, and the custodian is supposed to hold financial reserves of some sort, cash, bonds, gold, something that is supposed to assure that the stable coins have a claim on assets that can then be converted back to the currency to which the stable coin is purportedly convertible. Now, many of you may be familiar with Gary Gorton, who is a finance professor at Yale. And he's written a couple of articles basically questioning whether the stable coin idea is actually valid in terms of the purported collateral, the financial reserves actually being real and actually being financial assets that people would perceive as legitimate collateral. For those of you who aren't familiar with Gary Gorton, the one thing I will say about him is that he was very much involved in the issues of the credit default swap thing that occurred at AIG, whether you want to call it a failure on the company's part, a bailout for the government, or however. Gary was very deeply involved in all of that and has interestingly not commented much on it publicly, but certainly is a very, very, very bright guy with a lot of inside knowledge of how large financial institutions work. Now, the way we're thinking about stable coins is the fact that if you think about derivative markets, when you have an OTC derivative, you have counterparty risk. You have a situation where the other party may owe you money, you may owe them money, but there is some non-zero probability that somebody, one side or the other, may not pay. And so the stable coins appear to be stable, or we can at least make an assessment of the potential risk of a purportedly stable coin, really in three ways. One, there's the possibility that the so-called collateral is held by somebody you trust, like depository trust company, clearing agent for most of the US stock exchanges. We could assess credit counterparty risk if the custodian entity has a recognized credit rating from S&P or Moody's or some other rating agency whose rating we believe. The other is if the issuer is publicly traded. For example, the cryptocurrency exchange Coinbase is now publicly traded. Northfield, my firm, will create our own internal credit rating, as we routinely do for any corporate bond issuer that doesn't have a rating from a major agency. So we have these three avenues as ways to assess the relative volatility or the relative risk of stable coins as opposed to the underlying cryptocurrencies. There are also cryptocurrency linked items, like there is now a cryptocurrency ETF in a couple of countries. There aren't any yet in the United States, but they do exist already in a couple of countries. There are some central banks of either nations or groups of nations that have tried to issue their own cryptocurrency. The first cryptocurrency recognized by multiple countries will be that of the East Caribbean Currency Union, which includes places like Antigua, Barbados. There are a whole bunch of islands in the Caribbean that use a common currency known as EC dollars. I once lived in the Eastern Caribbean, and at the time, EC dollars were about 38 cents a piece. So a cocktail, much as I'm holding now, at a good bar was about $1.15, 3 East Caribbean dollars at the time. Interestingly, the nation of El Salvador, which has no currency of its own. If you go to El Salvador, everybody uses US dollars. There is no local currency. That's also the case in Zimbabwe. But El Salvador has recently recognized Bitcoin as legal tender. So if you're in El Salvador, you can pay things in Bitcoin or US dollars. They now have 2 currencies, neither of which they actually issue. And, you know, we're going to do our normal stuff with any equities related to cryptocurrency businesses, like the Coinbase exchange, which has gone IPO. There are also a couple of cryptocurrency mining companies that are now publicly traded in the US. One of the interesting things about this, of course, is that if we can observe historical volatility, but the combination of convenience yield and interest premium, this idea that if you're holding Bitcoin in a savings account, you get both the interest and the purported interest, and you get the convenience of anonymity. We're thinking that that's worth to most investors something on the order of 12 to 13% a year. And if you do out the logic of this process, that implies that in equilibrium, the volatility of major cryptocurrencies like Bitcoin and Ethereum has to be at least around 72%, that lower value of a 12% yield times 6. And the 6 is actually a constant, which is derivable both from a paper by Mark Rubenstein from 1975 in Journal of Finance. That may be a typo. It might have been 1976. And also 2 papers by our frequent and most recent presenter, Jared Wilcox, both of which appeared in Journal of Portfolio Management, one in 2000 and one in 2003. And if you go through the logic of the process they describe, what you end up with is that you can make an inference about investor risk aversion that says it is typical that an investor will trade off 1 unit of return for 6 units of volatility. In fact, it's directly derivable from the Rubenstein paper. The other thing that we can use to help assess cryptocurrency volatility is that there is a Bitcoin volatility index, very much like the VIX for the S&P 500. Now, it's very, very thinly traded. There's not a lot of volume in this thing. So it's questionable whether it's realistic. As of yesterday, when I did these slides, the implied volatility from the BVOL index was around 75, which again is consistent with the 72 on the left-hand side of this page and the number of 80, which came out of the Alexander and Mirage paper. So it's a lot. And one thing to keep in mind, of course, is that what matters to investors over multiple periods is compounded returns. And with something as volatile as 80% volatility, you have to very seriously consider the concept of variance drain. If something goes up by 80% and then down by 80%, you're not back where you started. You're a lot lower in value than where you started. Similarly, if you go up 80% and then lose 80% of that higher value, again, you're not where you started, you're a lot lower. And so geometric returns and arithmetic mean returns are different, and you have to account for that difference, particularly when volatilities are large in arithmetic terms. Now, why would investors hold assets that are that volatile? And particularly, why would they hold large amounts? You might think of somebody holding a small position in a small cap stock as part of an overall equity portfolio, but there are a lot of people for whom cryptocurrencies are their portfolio. And you would have to wonder why they would do that and why they would think that would be logical. And the answer really is that when we talk about volatility, we normally talk about it in annual terms, but investors of this sort typically think of things not in annual terms, but in terms of how much risk am I of loss do I have before I can get out. And if I think I can get out of my position, sell it in an hour or a day or a minute, I may think that the risks are a lot lower. It's not so bad. I'm not having that much risk of loss because I know if I'm attentive and I believe I'm going to suffer a large loss, I can sell and get out before that happens. I'm not saying that's a good rationale, but I'm saying I believe that's the rationale of many people. Now, under our usual IID sort of assumptions, 80% per annum volatility is about 5% a trading day. So a 3 standard deviation kind of event, 99 point something probability in the tail would be something like a 15% loss in a single trading day. Even if we sort of fatten the tails up, assuming that rather than being normally distributed, the returns are something like a T5 distribution, we end up with about a 20% loss for a 3 standard deviation event. And so that might be something that an investor would be willing to live with. I can lose 20% in one day, but I think I can get out in one day, so my losses won't be bigger than 20%. However, there are counterfactual cases. For those of us who are old enough to remember October 19th, 1987, the entire US stock market went down about 22% in a single day, lost what was then about $1 trillion in capitalization. But what is surprising about that event, not only was it an extreme move, 22% in a single day, but there was only $15 billion in trading volume. So the effect at the level of market capitalization was roughly 70 times the amount of dollar trading volume. So if we think that the entire cryptocurrency world is maybe 2 trillion, it wouldn't take very big trades to sort of upset the apple cart and create situations where liquidity, I believe, could go to zero. Now, part of what created the October 1987 problem was system failures, computers at the New York Stock Exchange, print queues, all sorts of mechanical issues with the networks. And when people figured out that they couldn't execute trades, they panicked. Clearly, a lot of blockchain capacity, the way in which cryptocurrency transactions are recorded and processed, is being added. One of the major cryptocurrencies, Ethereum, has just made a big deal out of the fact that they have greatly increased by orders of magnitude their processing capability using a particular process where they've increased hardware and done all sorts of things centered around London, so as to make their system more resilient to a spike in trading volume. However, we still think there are material geopolitical and operational risks to cryptocurrencies. As I said, there have been 3 major hacks of more than $500 million stolen in each case. And there have been many incidents of smaller circumstances and thefts. There have also been many cases, one that's gotten a lot of publicity recently, of people losing computer files and being unable to get the money or the value out of a Bitcoin or cryptocurrency wallet, where they've purchased this stuff, put it in a quote virtual wallet, and then were unable to get it out because they've lost a file or forgotten a password or something of this situation. So even rightful owners, by virtue of their own doing, have in fact lost value without any malevolent actor from the outside. As I mentioned in passing earlier, there has been a lot, very recent increase in regulation of crypto mining and trading, particularly in China and other Asian countries. And the other thing that's happened recently is that law enforcement agencies have figured out, to some degree, how to trace stolen cryptocurrency. As you may recall, a month or two ago, there was the Colonial Pipeline case, and the US law enforcement community represented by the FBI was able to recover significant amounts of the ransom paid for this ransomware incident. And it seems to me that this may have a perverse effect in that while it may make cryptocurrencies safer for some people, in the sense that if something is stolen, you might get it back, it may also reduce the acceptability and attraction of cryptocurrencies to those participants who are seeking anonymity. If you're a drug dealer and you're trying to hide money, the fact that law enforcement might be able to figure out where you're hiding it is less attractive than the belief that the anonymity is absolute. And clearly, this came up recently in the Poly Network case, this most recent hack, where the thieves have returned about half the money because it was made clear by cryptocurrency participants that they could trace where the money went and to whom it went, and said, if you give the money back, we won't chase you. And about half the money has in fact been returned. So now I just want to take you to wrap up through just an algebraic procedure for how to add this idea of operational risk into the market risk of cryptocurrencies, or for that matter, any other asset. It's just that with cryptocurrencies, it seems to be a very economically material effect. And we're going to propose a very simple 2-state model. And in one state, there's an incident. There's a theft, there's a lost key, there's something bad happens. And it has, the probability of that is P, and there is some expected loss, L, and the expected loss has some standard error that I'm going to call S0. And in the other state, things are normal. So we have a probability of 1 minus B. If nothing bad happens, things are normal. And we as investors had some expected return. That's why we're investing. I'm going to call that E. And there is some volatility associated with that expected return that I'm going to call S. And I'm going to combine those two states into a single distribution using what is known as a mixture of normal distributions process. There's a good paper by Robertson and Fryer in a statistical journal from 1969. And when I combine the two distributions together, the resultant combined distributions will have 4 moments. And in this case, given the parameters I'm going to put in here, we're going to see negative skew and positive excess kurtosis. I'm hypothesizing the potential of a large loss through this operational incident, and it's going to create fat tails. There's some extreme events that might take place. And I'm going to then take that 4-moment distribution and say, as a matter of transparency, as a matter of understanding the economics of this, I'm going to convert that 4-moment distribution back to the closest fit 2-moment distribution as a particular quantile of confidence interval. So I could say something like, given my desire for a 95% confidence interval, what 2-moment distribution, normal, mean, standard deviation, is the best fit to the 95th quantile of my 4-moment distribution? And the algebra of this was put forward by Cornish and Fisher in 1938. And here, rather crudely represented visually, are the formulae for the mixture of multiple normal distributions. I only have 2 in my world, but these formulas are general. So you could have 3 states, 5 states, 10 states, it doesn't matter. But I do the arithmetic, which you can see is just simple sort of high school algebra. And I can get the 4 moments of the combined distribution. And this is what Robertson and Fryer put forward in '69. I then take those 4 moments after I've calculated them and stick them into what is known as the Cornish-Fisher expansion. And this is something that looks very much like a Taylor series in calculus, but it's basically a what's called an affine expansion of any particular 4-moment distribution, conditional on the choice of a confidence interval. The one thing I don't think I put on this slide is that I did the arithmetic here, assuming a 95% confidence interval. And the link at the bottom of the slide is just a link to the original Cornish-Fisher paper translated to English. The original paper was actually written in French, so not a whole lot of people read it back in 1938. It was subsequently translated to English and has become better known since then. So just take you through a quick hypothetical to wrap up. I'm going to say that our regular state, that nothing bad happens, no theft, no hack, no loss of private key, has a 999 out of 1,000 probability per day. So there's a 1 in 1,000 chance that something bad happens during each trading day. And if nothing bad happens, I'm going to assume we have a daily volatility for my cryptocurrency asset of 5%. And I'm going to expect an arithmetic return of 0.1% per trading day. So 25, 30, 40% a year with compounding. But that would be if the return was steady. With a daily vol of 5, it's not going to come out that high. And then I've got this other state where an incident occurs. I'm going to assume the probability of that is 1 per 1,000 during each trading day. And I'm going to assume that if there is an incident, I lose 80% of my wealth with a standard error of 3. So somewhere between 70 and 90% of my money, my cryptocurrency money, is gone. And again, these are all generalized formulas. You can stick in any numbers you want. And if you combine the two, what you get is a combined daily volatility of about 9% a day. So 5% coming from the price fluctuation in the cryptocurrency, and the other 4 and a bit coming from the operational risk, the fact that there is this threat of loss or theft or casualty, if you will. And if we then annualize that 908 the way we would for a typical security like a stock or something like that, we get a vol of 144 per annum, a variance of over 20,000. This is a very, very, very volatile asset. Very, very, very risky. Now, if I cut the probability of this incident from 1 in 1,000 per trading day to 1 in 10,000 per trading day, then the influence of the operational risk becomes almost negligible. We had a market volatility of 5 per day, and the combined market risk and operational risk had a frequency of event of 1 in 10,000 trading days, once every roughly 38 years. You know, the effective volatility is just a bit over 5.07. So obviously the estimation here is very sensitive to the frequency of these kind of events. Now, the other thing is that cryptocurrencies are very volatile. If I applied this same approach to something like a bond portfolio, which had very low volatility, then the relative effect of the operational risk issue would be that much larger. However, an operational risk in a bond trade is unlikely to deal with an 80% loss. You're probably able to sort out the paperwork at some point and lose a couple of percent, but probably not 80. But again, the way I've done the problem is universal and applicable to any financial asset where you want to combine market risk and operational risk into a single number. So to just wrap up, what I've described tonight is the analytical process that we're proposing for cryptocurrency. It's similar to what we do now for commodities and currencies. The assessment of volatility, market risk is really very dependent on the having some very nuanced and hopefully thoughtful ways of understanding the fact that the returns here that we might observe with cryptocurrency are not stationary, are not IID. And so a lot of our sort of basic, let's observe the volatility and assume that going forward, really doesn't work very well. We have to be a lot more thoughtful in the way we think about volatility than just assuming whatever has been historically true is an efficient estimator going forward. The other thing I would just wrap up with is that if we want to include operational risk, I think I've given you a framework for doing that, but understand that the resultant combined volatility estimate, which you can use as kind of a risk measure or convert to VAR or CVAR or any sort of other popular risk measure you might want to have, it's extremely sensitive in this case to the frequency or expectation of the frequency of an incident. In the example case I've given you, at a frequency of 1 incident event per 1,000 trading days, the effect is profound. At a frequency of 1 per 10,000 trading days, the effect is de minimis. And So how you estimate that frequency will actually be the subject of an article in our December newsletter. There is a short article coming in the September newsletter on cryptocurrency mechanics and risk in general. But the issue of the operational risks will be covered in a short article in the December issue. So I'll stop there and hopefully try and read any questions that have been put in the chat box.
I think there are two
But
questions.
Dad, can I ask a question straight out?
And just
There are two
let
questions.
me
from
look at the chat
window.
box first.
Okay.
Yeah, just two things in the chat box. One is that Lucas has mentioned that there's a video online, and there's a link to it as to whether the stablecoin Tether has or does not have legitimate collateral. This is one of the coins that Gary Gorton has commented on. The other question was from Eric, which is, how do we create a rating for an entity like Coinbase that has no reliable financials? Well, the answer to that is essentially we use a process very similar to the Merton contingent claims process. However, it's driven off our equity risk models. It's not done the way Merton did it back in 1973. If you think about it, that the Merton process is basically an option model. Shareholders have the option to walk away and give the assets of the entity to the bondholders. You can think of it as a put replication. And in any option, the key valuation parameter is the volatility of the underlying. And the way we estimate that, or the way we frame that question, is how volatile would a company's stock be if the firm had no debt? The firm without its debt is equivalent to only the assets of the firm. And given the nature of our equity risk models, we can answer that question in a variety of ways, some of which are dependent on financial statement data, some of which are not. And so we run it through sort of our version of the Merton process, calculate PD, LGD, and then map that onto historical experience for traditional ratings. So we can take our probability of default estimate, our loss given default estimate, and say, if we mapped that into the historical experience of Moody's ratings or S&P ratings, would that be a single A, a double B, a single B, a triple A, or what have you? And that's really how we do it. And we now do it for something like 80,000 entities around the world. So basically anything that we run across that doesn't have a credit rating from a rating agency we trust, we create it ourselves.
What if the underlying asset is
I'm
itself,
done.
What if the underlying asset is itself an option, like a cryptocurrency? So the equity is effectively compound option.
Well, again, if it's the compound option, then you're basically looking at the same algebra as a variance swap, right? It's an option on an option. And there's a whole bunch of papers by Peter Carr about how to value things like variance swaps.
Yeah, so I think that, you know, a lot of people do think about cryptocurrencies like an option. There's this asymmetric upside. A lot of it's speculative as opposed to in practice today. They're supposed to have a utility to them. But I think that thinking about them like an option and that, hey, I'm risking so much, but some of these cryptocurrencies have had extraordinary gains. That's how I think a lot of people think about them, like options. And as far as, variance swaps and thinking about like extending this framework into a compound options framework, which has an analytical solution itself. And then, yeah, the Peter Carr kind of 1/k, strip of regular call options is another good framework for maybe thinking about that too. And, the variance kind of being, maybe more conditional with time too. So yeah, I think that's overall, Dan, excellent job presenting all the different qualitative factors that are associated with cryptocurrencies and incorporating a lot of the latest examples too. And I think it's an excellent overview, and thank you for the excellent talk.
Well,
Yeah.
all I can say is it kept me busy and it kept me from drinking enough. But I will catch up as quickly as I can.
Right. All right. Thank you, Dan.
Dan, a note on,
Okay,
when you
guys.
started with hoteling, you said a limited supply, or hoteling is also applied to cost of finding, which would both apply to
Yes.
the currencies, because the cryptos, because there either is going to be a limited supply or it costs a lot of money. Second thing was the banknotes. Banknotes are, I think, equivalent to Citibank just going out and issuing a CDS. I don't know. And the third thing is, let me put this up here. It's backwards because it's on the camera.
You still
Years
have that
ago,
Not backwards,
very long time ago.
Yeah.
that's right. Years ago, that was the first time that somebody showed up at Quaffaview and was giving away Bitcoins for $5. And there's the back. Don't scan it because I may still have $1 on there, but I've tried multiple times to get it off, and I cannot find I can't get the password out of it. So
Yeah, they brought in
So
their
there's your operational risk issue.
there
Right.
you go.
You
Yes,
lost
it was a
the
teller
private
machine.
key.
They had a teller set up in the South Station,
yeah.
and you could put dollar bills in and get Bitcoins out, but you couldn't put Bitcoins in and get dollars out. Do you remember who they were? I mean, you must.
It's Chris Yin comes to mind. So I think he's
long
got
story. Chris Sim and we were at an accelerator called Mass Challenge way back in 2014.
Ah.
And I had asked Chris Sim to join us at Quaffaview because he was looking for financial folks. Where do financial folks gather? And I said, Quaffaview is one of the organizations, and you may have some ideas of, potentially introducing Bitcoin to some of the financial folks. So that's how it kind of came together. So Chris came down to Quaffaview to demonstrate the Liberty Teller ATM at that point.
If he could get me half, I'll give him half of the whatever is on this card.
I can buzz him to see where, I haven't been in touch with him.
I would love it. Thanks. Thanks,
Yeah.
Sri.
I think he's got a LinkedIn.
Okay, everybody,
profile.
I better go feed the dog before it starts barking
All right,
again. Good
and
night.
we're looking for a speaker for next month, and operators are standing by for October 13th.
All right.
Okay.
Thanks, Dan.
Good night, everybody.
Are we in
Thank
person?
Hi,
you.
everyone.
Thanks,
Are we
Dan.
in person next month?
Stay tuned.
Okay, and if we're in person, is there food and drink?
Vipul, you're always worried.